We're all dealing with the same problem right now. Inflation. Groceries? Up. Gas? Up. Rent? It's through the roof. You know what's not going up as fast? Your savings sitting in a bank account earning barely 1% interest. Here's the reality. $10,000 today won't buy you what it did 5 years ago, and that trend isn't changing anytime soon. So how do you fight back? Well, you don't need to be a Wall Street pro. The answer is simpler than you think. It's bonds. Now, I know what you're thinking. Bonds? Aren't those for retirees or finance nerds? Nope. Bonds are for anyone who wants their money to grow while keeping it safe. And with interest rates higher than they've been in years, bonds are more attractive now than they've been in a long time. In this video, I'll show you and John everything you need to know about the bond market, the types of Treasury bonds out there, how much you can earn from a $10,000 investment in these bonds, and in the end, I'll show you better options than bonds to double or even triple your returns. So let's clear the air. Bonds might sound complicated, but they're actually one of the simplest financial tools out there. At its core, a bond is just a loan, and in this case, you are the lender. You're lending your money to a borrower, whether that's the US government, a corporation, or even your local city. In return, they promise to pay you back with interest. That's it. No fancy jargon, no complicated math. Here's an easy way to think about it. Imagine your super reliable friend needs $100. You agree to lend it to them, but on one condition. They pay you $5 every year as a thank you for trusting them. After a set number of years, they'll give you back your original $100. That's essentially how bonds work, but instead of your friend, it's Uncle Sam or a big company borrowing from you. And that annual thank you, that's called the coupon or the interest payment. Now, bonds come with a few key parts you need to know. First, there's the principal, which is just the amount you lend, say $10,000. Then there's the interest rate, or the coupon, which is the percentage of your principal that gets paid to you annually. Lastly, there's the maturity date, which is the day you'll get your full $10,000 back. Let's make this real. Say you invest $10,000 in a Treasury bond with a 4% interest rate. That means you'll get $400 every year until the bond matures. If it's a 10-year bond, you're walking away with $4,000 in interest by the end of the term, plus your original $10,000. But not all bonds are created equal. Some are short-term, like Treasury bills, which can mature in as little as a month. Others are long-term, like Treasury bonds, which can stretch up to 30 years. And the best part, most bonds are backed by incredibly reliable entities, meaning the chance of losing your money is slim to none, especially with government bonds. Now that we've got the basics down, let's see the different types of bonds out there. They may all follow the same core principles, loan, interest, maturity, but the details can vary wildly. Knowing the differences can help you figure out which type works best for your $10,000 investment. Let's start with the big one, Treasury bonds. These are issued by the US government, making them the safest option around. They come in a few varieties. First, there are Treasury bills. These are short-term, maturing anywhere from a few weeks to a year. Then you've got Treasury notes, which last 2 to 10 years. Finally, there are the big players, Treasury bonds, maturing in 20 to 30 years. What makes Treasuries special is their reliability. Uncle Sam has never missed a payment, which is why those bonds are considered virtually risk-free. Next up, let's talk about corporate bonds. These are issued by companies looking to raise money for expansions, projects, or just day-to-day operations. Corporate bonds offer higher returns than Treasuries, but there is a catch. They're riskier. If the company goes bankrupt, well, you could lose your investment. However, if you pick a financially strong company like Apple or Microsoft, you're likely to earn a higher yield without too much risk. Then we have municipal bonds, or munis for short. These are issued by local governments like cities or states to fund public projects like bridges, schools, and highways. The best part? The interest you earn on most munis is tax-free at the federal level, and sometimes even at the state and local levels. If you're in a high tax bracket, that can be a huge advantage, making a 3% yield on a muni potentially more lucrative than a 4% yield on a taxable bond. Then there are savings bonds, a beginner-friendly option. The U.S. government offers two types: Series EE bonds, which double in value over 20 years, and I bonds, which adjust for inflation, helping your money keep pace with rising costs. Lastly, international bonds bring diversification and occasionally higher yields, as they're issued by foreign governments or corporations. However, they come with added risks, like currency fluctuations and geopolitical factors. So how do these bonds stack up? Treasury bonds are your safest bet, perfect for a solid foundation. Corporate bonds are the risk-reward play, offering higher returns if you're willing to take on a little uncertainty. Munis are ideal for high earners looking to maximize tax advantages. Savings bonds are simple, no-fuss options for beginners, and international bonds, well, they're for investors who want to diversify globally. In a couple of minutes, I'll show you and John how much you can earn from a $10,000 investment in Treasury bonds. And in the end, I'll show you better options than bonds to double or even triple your returns. Bonds might not have the glitz and glam of stocks or the allure of real estate, but they come with their own set of perks and, yes, some drawbacks as well. Let's break it down so you can decide whether bonds align with your financial goals. First, bonds are a safe haven, especially Treasury bonds, which are backed by the U.S. government. For risk-averse investors, this level of security is invaluable. Second, bonds offer predictable income through regular interest payments, making them ideal for retirees or anyone seeking steady cash flow. Third, bonds help balance your portfolio by stabilizing returns when the stock market fluctuates. On the downside, bonds have lower returns compared to stocks, making them less suitable for those chasing high growth. They also face an inflation risk, as fixed payments may lose purchasing power if inflation outpaces the bond's yield. Finally, there's interest rate risk. If you sell before maturity and rates have risen, your bond's value might drop. All in all, if you value stability, predictability, and steady income, bonds are a great fit. They're perfect for saving towards specific goals, providing reliable cash flow for retirees, or balancing a stock-heavy portfolio. However, if you're chasing high growth and can handle market swings, you might focus more on stocks or real estate. That said, even in high-growth strategies, bonds provide a financial safety net. Now comes the part you've been waiting for, figuring out how much your $10,000 investment in a Treasury bond can actually earn. For this video, I'll be using the 30-year Treasury bond that has a yield of 4.6%. This type of bond is one of the most stable and reliable investment options thanks to its backing by the U.S. government. So let's break it down. If you invest $10,000 in a 30-year Treasury bond with a 4.6% annual interest rate, you'll earn $460 per year in interest. These payments are typically split into two semi-annual chunks, meaning you'll receive $230 every 6 months. Over the full 30 years, the total interest earned would amount to $13,800. And this is before considering any potential compounding effects if you choose to reinvest your earnings. What's more, your original $10,000 investment remains intact and is returned to you at the end of the 30 years. So in total, you'll walk away with $23,800, $13,800 in interest plus your original $10,000 principal. But what happens if you reinvest those semi-annual interest payments? Instead of pocketing the $230, you could reinvest it into other Treasury securities, such as short-term Treasury bills or notes, earning similar yields of 4.6%. By reinvesting, each payment starts generating its own interest, creating a compounding effect that grows over time. Over 30 years, this strategy could increase your total earnings significantly. Instead of $13,800 in interest, compounding could add an extra $6,000 to $8,000 in your total returns, pushing your financial balance to $30,000 or more. This approach does require some effort, manually reinvesting or setting up automated reinvestment programs, but the rewards can be well worth it. So instead of settling for a predictable $23,800, reinvesting can let your $10,000 grow even further. Now that we've covered the nuts and bolts of bonds, let's see how they stack up against some other popular investment options, focusing specifically on high-yield savings accounts and stocks. To make it real, we'll compare the performance of a $10,000 investment in each of these over 30 years. Let's start with the high-yield savings accounts. These are the most used options for the average investor. Your principal is insured, usually up to $250,000 by the FDIC in the US. So there's virtually no risk of losing your initial deposit. The trade-off? Lower returns. Let's assume you park $10,000 in a high-yield savings account offering a 2% annual interest rate. At 2% annual interest, compounded monthly, your $10,000 would grow to $18,219 over 30 years. That's an $8,219 gain, solid for safety, but it pales in comparison to other investments. The biggest drawback here is inflation. If inflation averages 3% per year, the purchasing power of your savings diminishes even as your account balance grows. In this case, the real value of your money could be worth less than it is today. And the next option is stocks. Stocks are often seen as a high-risk, high-reward investment, and for good reason. Historically, the stock market has delivered average annual returns of around 7 to 10% after inflation. While stocks can significantly outpace bonds over the long term, they come with much greater volatility. Let's assume you invest $10,000 in a diversified stock portfolio with a 7% average annual return. At 7% compounded annually, your $10,000 would grow to $76,123 over 30 years. That's an impressive $66,123 gain. Over 3 decades, bonds emerge as the perfect middle ground. They're safer than stocks, more rewarding than savings accounts, and far less hassle than real estate. While they might not steal the spotlight with sky-high returns, they'll do their job, growing your wealth with stability and predictability. Now, if you have more room for taking risk and want to explore better options and returns, click the video on the screen to see how to turn the same $10,000 investment into a $1 million portfolio.